Hello and welcome to this very, very special episode of Investor's Guide as we prepare for a brand new year. This is a two-part special, the other half of which will air at exactly this time next week. First of all, Merry Christmas to all of you at home. I hope you're having a wonderful weekend. We have such a wonderful special show planned out for you today. I want you to take a minute to grab a pen and paper because the advice you will gain on this show today will be absolutely invaluable. And I know why the advice is going to be so fantastic, because we've put together the most wonderful panel of experts for you. A quick round of introductions. Rashesh Shah from Edelweiss, Raamdeo Agarwal from Motilal Oswal, and of course our very own Dhirendra Kumar from Value Research. Between our three guests, we've covered every possible financial investment. And here is the best part about this show. We have audience in the studio. They're all investors just like you and me, and they're going to be asking the questions today. Not me, which is why I'm sitting among the audience, and the gentlemen on the panel are going to be doing all of the work. But just to get the ball rolling and to get started off, as we enter the new year, I want to talk about what opportunities we're going to get in this new year. And I don't want a one-year call on anything from each of you. Assume I have a 10-year horizon or a 20-year horizon. I'm investing my hard-earned money. In 2015, what opportunities might I get to add to my long-term portfolio so that when I retire, I would have taken advantage of these opportunities and I would have gotten rich in the meantime? I want this answer from each of you, so I'm going to start with Rashesh. Rashesh, what opportunities are you expecting for long-term investors in 2015?
I think this is going to be a year where equity as an asset class, as well as any fixed income investment will also do well, because I think the way things are going, the way inflation is falling, interest rates will come down. So quite a few investors, if you can buy a 3-year FD or a 5-year FD or even a 10-year FD or a 10-year bond, I think all those will also be good investments. Equity obviously has been a good investment all through 2014. I think it is we are going to see a 4 to 5 year economic revival in India. Corporate earnings are going to be in an uptick, and any investor looking at a 3, 5, 10-year horizon, I think equities will be a good place to be in 2015. So I would say equity and bonds.
Raamdeo, will 2015 be the year to buy right and sit tight?
Yeah, see, equity is, except for extremes, equities are always a terrific asset to buy in, because equity is not about very short-term call you're making whether you are in or not. I mean, it's like owning your own business. So since you don't have your own business, you buy others' businesses at reasonable price. So businesses don't prosper overnight. They take time. So you have to allow that time. You got to have a little vision to see that, and a bit of courage to believe in yourself that yes, you could see what this guy or this company is going to do. And then have patience to hold on, because nothing happens in 1 or 2 years. So that combination you have to bring here, and even in very bad market, very expensive market, you can get ideas which could be implementable. So, and particularly if you're buying truly for 15, 20, 30 years, you close your eyes and you can buy equities, high quality equities. High quality. Quality is very important, because in equities what happens is there are a lot of uneven ground, because you get good quality companies, you get bad quality companies. Time is friend of good companies and equally big enemy of bad companies. So you have to make sure that you buy quality companies and stay on for 10, 15, 20 years. Equities you can buy any time except for absolutely euphoric time. That's the time you should avoid, but I don't think this is euphoric times.
I'm going to ask you a question that all investors, I'm sure, are thinking about at this point. It's wonderful what you just said to us, and there was a very interesting report that came out from Motilal Oswal, authored by you, about companies that have done 100x for us up till now. Yeah. How do we find the good companies vis-a-vis the bad companies? Because therein lies the entire, investment beauty. So give us that checklist that we have to use to find those good companies.
What you need to have is a little bit of vision in terms of is this company going to become bigger, and the business opportunity, and why it is so inevitable that this company will become very, very large in the days to come. I mean, investing is all probabilistic event. It's not anything 100% to start with. But because of your understanding of the company and the situation, competition, it's always very unique. So when you look at that company, and the company has to be rather unknown when you hit that particular company. Then second is the quality of management. I think that's where it is, as it is said, 90% is management, 9% business, and 1% everything else. So you have to focus that much into the quality of management. the management has very clearly 3 traits you require. One is the competence, whether that business anybody is doing, whether he is really fanatic about it. He has to be mad after that business and very competent. Okay, so that's first part. Second is that he has to have that energy, which I was saying, passion and long term, kind of he wants to die only for that. If somebody is doing yoga, he has to be doing 24/7 yoga only, that kind of guy. Then third is the value system, the highest level of integrity and the honesty, because that's the only thing you can predict. If the guy has the competence and energy and he's a crook, then you cannot actually predict where he's headed. So for 20 years if you're buying, you need good business, terrific management and very reasonable price. Typically price is not that much of issue. Today market, everybody is worried about the price. Actually price is the least of the problem. If you have the good business, very high quality management and little unknown in the marketplace, So yes, you have to buy at reasonable price, but once you have this 3 combination, then you must buy and hold. That's a buying right, and now sitting tight is your problem.
All right, so a formula there from one of the most successful investors in our market. Dhirendra, you have through this show in the last 6 years illustrated that a simple SIP in a good fund held for a long term can actually show you the power of compounding. Do you think the new year will throw up new opportunities, or do you think it just makes sense to continue your SIPs, do nothing, stay on plan?
Investors should look at 2015 as another year. Most Indians have no plan in place. They should get to some very basic planning, which is the money which you need in next 2-3 years, have it in your bank account or some income fund or some liquid fund, depending on the time frame. Don't mess with that. It's bad to have a great investment which you can't rely upon when you need it. Get that insurance if you have dependents, and get the cheapest, and look at insurance as a cost, and it doesn't cost all that much. Get that health insurance, otherwise all your savings plan will go haywire. And rest of the money, if you have the time, inclination, do it like Raamdeo. You will not regret it. In fact, it will be so rewarding that you just might change your profession. If not, then choose a good fund, invest regularly, and don't get distracted, and look at all the new years as just another year. Don't change your plan because of a change of year or change of season, or this Diwali, that Diwali. No, it should be a 20-year plan. I think your discipline has the potential to deliver you the performance, not the market.
Another small thing onto this, what we have seen over the years is the ideal way investors should start is have an asset allocation process, and it's up to you whether you want to tweak the asset allocation every year at the start of the year, or you want to try and do it every quarter. But anything under a quarter is not a good thing, because then you are like really playing on the short term changes that are happening. But either on a quarterly basis or an annual basis, you should decide what kind of asset allocation you want, and you can tweak it around, because as your income changes, as your risk profile changes, as the market environment changes, you could tweak around that. And after that, and you should have some part in bonds, some part in equities, some part in other assets. And then when you have it in equities, either go through the mutual fund route, which we're very fortunate in India, there are some very good mutual funds which have outperformed the market over the years, or actually do the stock picking, which can also be very exciting, and it's a highly educative process. So it has to, according to us, start with an asset allocation, and you should review your asset allocation maybe at least every year, so that you know that it is calibrated in the right way.
All right, words of advice there from some of the strongest investors in our market. Very simple. Make sure you have an emergency fund, health insurance, life insurance, and then look at the asset allocation of your entire portfolio as a family or as a unit if you have to. And each of them, they're giving you advice that you should actually be taking down at this point. We're going to take a very quick break. When we come back, questions from our audience and answers from our experts. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. This is our very special year beginning episode. This is the first half, the other half of which will air next week. We have 3 wonderful guests in the studio, and I'm not going to waste any more time because we have a lot of questions from our audience. You have a question? Yeah. Go ahead.
Hello sir, my question to you is regarding the real estate investment trust vehicle that has been, the guidelines have been issued recently. So I wanted to ask, what are the prospects that it holds for a investor and an Indian investor?
Most of the REITs all over the world are a good combination of what is called yield play, because it's almost like a bond. And then if interest rates come down, usually REITs appreciate, or if the commercial real estate values go up, REITs appreciate. So REITs usually should give you about 8-10% kind of an yield at current interest rates, and then you should have appreciation which is expected to be hopefully 3 to 5% on top of that. So it's ideally going to be a combination of yield plus some amount of upside kind of an instrument. And the other good thing about REITs as and when they come about is they will be a long-term investment. Usually an REIT life is 8, 10 years, 15 years. So you can really buy, like as we were saying earlier, if you are a retiree and you want some income with a little bit of capital appreciation, REITs may end up being a good investment instrument for that.
I'm going to take a question from the lady investor at the corner. Go ahead.
Hi, my question is for Dhirendra. You have always advocated SIPs, but what would you say for retirees who get a lump sum from their company when they retire, something like say 50, 60 lakhs? SIP wouldn't be the way to go then. What would you recommend for retirees to do when they get that lump sum of money?
First and foremost, I would say that the retirees should plan for. First and foremost, they should estimate their income requirement. Everybody has a need, and maybe the changed circumstances will lead to some changes, but you can still reasonably estimate that, and that should be put into in a form, in a manner that your need for predictable income is derived from that, whether it be senior citizen savings scheme or your pension plus some rental income. It could be anything. It could be a combination of these. Rest of the money should be conservatively invested in a mutual fund, but not at one go, because there is a risk of that. There is a risk of catching a market peak. For example, today everybody is excited, but one cannot rule out a possibility of a 15% decline over the next 3 months, which could be very normal in case of equity. And it should not matter if you are going to invest for 20 years. But the problem is that for a retiree, it becomes too much of an anxiety. Your lifetime savings going down by 15% in 3 months flat, what you have earned over the last 30 years. So to manage your own anxiety, it should be spread over a period of time and invested in a more calibrated way. So your fund selection should be different. It should be tax efficient. It should be substantially into equity, because I am talking of the money which you are going to invest, which is beyond the money which will be deriving income for you. So that should be done in a calibrated way. Spread it over next 6 months, 1 year, 1.5 years, depending on your tolerance of a declining phase. So it's a very simple thing. Choosing 2-3 balanced fund, investing in it. That is what I did for that's what I advised to retirees.
All right. So in fact, we have a stable growth portfolio that we've been running on this show for the last 6 years. And we're going to put that up on the screen, and someone will email you a copy as well. And we're assuming that you start off with the senior citizen savings scheme if you're above the age of 60, which is a good, efficient way to generate an income as well. You, sir, have a question as well. Yeah. Go ahead.
I have a question. I have a son who is differently abled, so he cannot take care of his investments. And I would like to understand where we can invest so that in the long term he gets good benefits, and also we as parents investing on their side, we get some tax benefits like Section 80D.
It all depends, what kind of income allocation for him one is doing. Say, just I'm assuming that you would like to part with some money now, whatever might be the collection, and then every month or every quarter you would like to top it up. So one of the things is that if you, this is seriously long, in the sense that he might be say 5 years or 7 years, and you want to see that, pardon?
He's 12 years old.
12 years. So I think he will need money once you, when he becomes bigger, and you will not be able to contribute at that point of time. So maybe it is 12-15 years away for you to draw out of that. I think the best instrument so far is the equities, but it has to be very necessarily high quality, conservatively managed equity, because equity is the only thing which will beat the inflation. See, one of the biggest enemy for you is to save the, you have to increase the purchasing power of what you give. If you give 1 crore today, or if you give 100 rupees today, he should be able to buy 200-300 rupees worth of inflation adjusted thing after 10-15 years. If you go to fixed income world over, not only in India, is only a inflation buster. If they are lucky, inflation is post-tax, whereas your income is pre-tax. I would think that a very high quality equity is the way to go. In the sense that it sounds a little risky, but if you can make it a SIP kind of thing where it comes in phases, but you got to continue when the market comes down. It is not important that you will keep doing it in the rising market. It is most important to buy in the falling market, because then you buy a lot more for the same money, and that is the way to go about it. And I think 17.5% has been the post-tax return from equity, which is the dumb equity, in the sense that we are talking about index. When you get a smart manager, getting 2-3% higher than that is not that difficult. We have brilliant managers. There are so many of them who beat the market hollow. So I think he has a good chance to make close to 20% if future is as promising as what has happened in the past. In that case, anywhere between 70-80, and in a 20-year basis, 20% compounded and a 7.5% fixed income. There is no, he will in 20 years he'll be a millionaire in his own right, and that's what you would want him to be.
Dhirendra, I want to very quickly ask you, so if we're looking at what Raamdeo has just told us, which is efficient equity, a smart manager, and he wants a tax benefit, would a conservatively managed equity-linked savings scheme be the way to go? Would you be able to give him a name that he can use?
For a 12-year-old child who is taken care of by, who is taken care of today, and he's likely to be, taken care of in foreseeable future till you are around. So you really have to worry about if you're not around, as and when, for that, so you should be investing right now aggressively, and for next 10, 15, 20 years. And after that, you should be, I would say that a very simple plan, that next 3 years income need is realized, kept in a fixed income, and rest of it works.
Right, it's time for us to take another very quick break, but in the meantime, you can write down our email ID and my Twitter account if you'd like to ask a question yourself. Come back after the break for more questions and answers. Welcome back. You're watching Investor's Guide. This is our two-part year-end special. We have a wonderful panel of experts who are answering questions from our audience. We're going to quickly take another question. You have a question, go ahead.
I have a question for Dhirendra. Now, we invest in mutual funds basis star ratings, right? But then sometimes what happens, and we review it say once in 6 months or a year, but sometimes what happens is like by the time we review it, my scheme could be like from 5 star to 3 star. Now, can we look at some leading indicators, as in to manage this? I mean, mutual funds is all about taking risks, but then is there any way we can manage that?
How often does a fund go from 5 stars to 3 stars?
Not very often. It generally doesn't go that often, and also you have to understand that this. I would suggest that you don't look at that star rating with that. Don't attach that much seriousness to it. Don't take it that seriously. For one reason, I think my star rating is extremely useful in identifying the low-rated fund. If you are able to avoid the lousy ones, you are much better off.
Rashid, I want to very quickly bring you in here, because this is what you'd mentioned a little while ago. If I put together, using all of the advice, a good portfolio, how often, if it's mutual funds, let's say, how often should I go back and review that portfolio, check the performance, compare it to, look at its star rating? At what point does it become damaging, and at what point is it useful?
Actually, I would also add to that, before I answer that particular question, that I think every investor, all the people who are watching this show, should also, when they are thinking about investment, they should ask some hard questions to their own selves in terms of what is the volatility they want, what is the outcome that they want. Because as we've been speaking, it just identify some good companies, buy and hold, but we know that it's one of the hardest things to do in life. So I think it's actually very good to start off by asking a few 4-5 very basic questions in terms of how much involvement do I want to have in managing the my entire portfolio. What is the review period I want, because it can be quarterly, it can be, and ideally if you ask questions to yourself, you will get the answers. But as I said, something between 3 months to a year is a good review period. I strongly believe that investors should review their portfolio. I think that there is a school of thought, just buy shares and keep them in the cupboard or in your demat account and forget about it. I do think that I think investing is an active kind of an activity. You have to be involved, but you don't have to be involved every day watching the TV and then buying, selling. Unless you are a professional investor. But if you are not a professional investor, and you are you've got other profession, you've got other business or other jobs to do, you want to have a quarter on a Sunday evening with your family, sit down and then say, okay, this is what how the portfolio has performed, this is how the outlook is, maybe I have a little bit money, I've got a raise, I can invest a little bit more, kind of a thing. But I think you should start off by asking yourself some key questions.
Raamdeo, do you want to add to that? What if I pick those really smart stocks and I'm sitting tight for the next, say, 10 years at least? How often do I have to review it? Because there's so much research, there's so much news, there's so many views on these stocks. How do I decide when I stop and say, okay, I'm only going to look at it once a quarter?
No, it's a constant process because companies are changing, they are becoming better, they are becoming worse. There could be fatal blow, there could be regulatory changes. See, companies die because of 3-4 things. One, because of disruptive innovation. Something you do which is suddenly become obsolete, like instead of fax something else comes and the whole thing is useless and you're holding it. Say MTNL, from a wired telephone to wireless telephone. And you're just holding MTNL shares, they become junk. So, you have to review the portfolios because new technologies are coming. Second is that there could be a change of management for good as well as better and worse. And many times a promoter dies or whatever happens and the company goes down the tube. So I think the whole issue is that you have to be 24/7 manager if you want to be. But such a wonderful vehicle has come called mutual funds, and you have all kinds of managers. And now I'm learning here that there is star rating which at least avoids the junk one. See, basically, like in gold market you go, you get all 24 karat gold if you ask for one, 100 rupees here and there. In stock market, the problem is you get 40 karat, you get 24 karat, you get 4 karat. And 4 karat has more shine than 40 karat. So, the people get dazzled, what to buy, what not to buy. And for that you need expertise. So, if you don't have one, you better follow mutual funds, and the experts are the guys who are managing the mutual fund. And these guys, they are saying that these are the experts who are at least can be relied upon. 3-star, 4-star, 5-star. I think that's the way to go and get your allocation right. If you get say 50% equity, 50% debt, and you don't know anything about the whole process of buying equities, go and buy one 5-star rated or 4-star rated whatever fund. Ask also around what is good. You don't know how big this country is headed in terms of economic upside. So in worst of the time when you had prime minister changing every 3 years or 2 years, you didn't know who is the prime minister, you can't remember. Then also we have done 17.5%. So now you have a prime minister whom you can identify with. So I think you have India is center of the world, as it is said. So I think you are likely to do somewhat better. So this is the time to get allocation right and get the process right of investing also.
All right, so this is the big learning. You have to get your asset allocation right. Investing in stocks directly is a labor intensive job. You have to track it on a regular basis. If you can't track it on a regular basis, then invest in a mutual fund. Track your mutual fund once a year with your family. If you have questions about anything at all you heard on the show today, write to us. Email ID is at the bottom of your screen. Next week is the second half of this show. Merry Christmas to you. Enjoy your weekend. Stay with ET Now.